strange session on the Aussie share market. As you mentioned, Kate, we saw that 6-year high for the Aussie market, and in fact record highs for the likes of ANZ, Commonwealth Bank, Westpac and Woolworths. But by the end of this session, all 4 of these stocks had been sold off and we saw some heavy losses. In fact, we also saw 52-week highs in the energy space, with Woodside Petroleum, Oil Search as well as Origin hitting 52-week highs. But once again, in the end, a very negative backdrop for the market. If we have a look at the market, we broke that 7-day winning streak. Every single sector was in the red by the end of the session, the worst being the consumer staples, which was dragged by Wesfarmers after its quarterly sales result today, and also dragged down by Woolworths after Woolworths hit a record high earlier in the session. There were some stocks which also saw 52-week lows, and it's worthwhile keeping an eye on these stocks as well. Myer was one of them. The other was St Barbara Mines. So it looks like the Australian share market very jittery around valuations, especially in terms of the banking stocks. If we have a look at the banking sector and just have a look at valuations in this space, and this is just over the last 10 years, and when looking at the PE ratio here, you can see that we've hit the upper end of the band. But really, in terms of the banks, we look at the price to book ratio, and in that regard, because we saw prices reaching record highs again, we're seeing these valuations once again at historical highs. So a lot of concern around these valuations, and that the share price movements that we've seen in the banks simply isn't going to keep up with the earnings and the dividend growth that we're going to see in this area.
Yeah, I also want to take the view, but things are slowing down a bit now. What's your outlook?
I think the problem with both Woolworths as well as Wesfarmers is that this is a mature industry. You know, when we see growth here now, we're probably going to see cannibalisation. Woolworths is a bigger player in this area, and that gives it an advantage because it means it's able to spread out its operating costs across more stores. We know that Wesfarmers is also looking to ramp up with 70 superstores over the next few years as well. We have a look at the actual numbers. The food and liquor actually did come in slightly below our expectations, and that's where most of the earnings are derived from, and that's what really drives the share price. And if we have a look at it on a like-for-like basis and adjusted for Easter, 3.5% is where it came in. We're expecting to see 3.7%. The growth areas, Bunnings as well as Officeworks, continuing to do well. We saw Bunnings growing at 9.1% and Officeworks at 5.2%. You continue to see problems in those discount areas like Kmart as well as Target, especially Target, which was down by 4.7%. I think the big thing to be watching with Wesfarmers though is capital management. We know they've now offloaded that insurance business, so we have to wait to see whether Wesfarmers is going to reinvest in growth and is probably on the lookout for acquisitions at the moment, or whether shareholders are going to get some of that cash back. But I think if you have a look at this sector as a whole and this industry as a whole, it is a mature industry, and it's going to be much more difficult getting growth out of this industry. Tomorrow we are expecting to see accelerating sales, and that's a positive for Woolworths. So we're expecting to see about $15.4 billion worth of sales come in, and that would be an increase of 6.5%. In that essential food and liquor division, on a like-for-like basis, adjusted for Easter, we're expecting to see growth of 3.8%, and that would mean for Woolies that's acceleration from the previous quarter of 3.4%. But all up, I think with Wesfarmers there's a little bit more room for some exciting plans because of the money that's going to come in from that insurance business. So in terms of valuations, I think Woolworths has run very hard in 2014. In fact, if we have a look at the share price performance in the year to date, Woolies is actually up by 12%, whereas Wesfarmers is down 2.5%. So I'd probably go with the underdog, Wesfarmers, at this stage, and just watch very carefully how they reinvest those funds from that insurance business.